Good morning, Harriet.
Even though we couldn't really talk so much to Gwadabe, that's the president of Bureau de Change Operators of Nigeria, for him to give us a look at really what the issues are. And he said so much. But in spite of that, one thing I know that I took away from that conversation is that we have people who are sabotaging the Naira, who are attacking the Naira, and that's one of the burning issues that we have. So Forex pressure continues to bite hard. And according to your analysis, wheat futures are up 1.33% to about $4 per bushel. What are the options for fast-moving consumer goods?
Well, for most FMCGs in Nigeria, we all know that we depend heavily on the importation of wheat for the production of Guinness or beers and all of that. And in the global market, wheat prices are actually much lower as opposed to what it was in the beginning of the year. But then prices of most grains are extremely volatile, and they're mainly determined by what supply-demand dynamics and weather conditions in major growing regions. Wheat prices are up yesterday, mainly due to increased imports from Russia. Increased imports from Japan, Morocco, and Egypt. But then, typically in the grain market, wheat and corn prices are lower. For most FMCG companies, like you rightfully said, FX scarcity remains a biting issue, although the federal government has stated that most commercial banks should allocate 60% to most manufacturers. But then, who exactly are these manufacturers? It is quite ambiguous, and you have the guys that import a lot of instruments or materials, but then you have guys that import a lot of raw materials. The problem still remains that they actually still don't have access to FX at the interbank rate, so they have to source for alternatives at the black market, which we know is actually above the roof. So what most FMCG companies are doing now, they must pass this cost on to consumers. But then, like we always say, consumer resistance is kicking in. We can't afford to continue to pay high prices. But then the good news is that most FMCGs are now sourcing for commodities locally. So we know that in the rice market, we expect a bumper harvest, and there's a lot of investment in the production of wheat, cassava, corn, and sugar. So in the very long term, we probably shouldn't depend so much on the importation of wheat from the US and the EU region.
But that doesn't mean that we wouldn't see the imported food, which actually contributes a lot to what we see when the National Bureau of Statistics releases results. The food prices, the food sub-index always shows an increase, and because of the imported foods. And listening to Alhaji Gwadabe, that's a very sticky issue for me. If you can, put a little more perspective. If, for instance, we have the Naira at the parallel market crossing 500 because it's already at 475, well, he's very, he's insisting that everything will be done. I don't know how to make sure that the Naira, actually comes down, eases up a little bit, and not at 475, because like you rightly pointed out, most of these companies actually source their Forex from the parallel market. So in the very short term, what do you expect, or how do you expect companies to react? And how do you also expect consumers and the other people who actually source for this Forex?
So the Forex market is actually, there are a lot of speculative attacks on the, on the dollar, and there's still panic buying as well, because most people are a bit panicky. I'm not sure where the exchange rate is going to be next month or next year. And then there's still the Forex illiquidity due to reduced inflows, capital inflows. I'm sure the federal government or Nigeria as a whole, or the financial institutions are doing whatever they can to make sure they somewhat stabilize the Forex market. But I believe why the Forex market spiked to about 500 is due to a lot of speculative attacks on the currency.
So what happens to the FX futures market? Because I do know that was one of the reasons why that particular segment of the market was launched. So that if you can't afford to get, just in case, you can hedge your funds, you can hedge your Naira. So 2 months, 3 months down the line, if you have to import any materials, those materials that are not prohibited, that is, from accessing Forex from the interbank foreign exchange market, you can hedge your funds using the FX futures market.
Well, that's true. That is why the FX futures market were there. But however, we've seen the consistency in the CBN meeting obligations. So people are still hedging. But if, like I said, if we don't have enough dollar inflows, we see that our production are somewhat picking up. If we have some sort of, and if there's some sort of renewed confidence in the Nigerian market, we'll see an influx of foreign portfolio investors as well as increased investment in Nigeria, and that should somewhat increase the dollar availability, which obviously will somewhat appreciate the naira in the long term. But the futures market is still, is still very active, and people are still locking into it. And the central bank has not defaulted in paying out its obligations. So that's good news.
Okay, so apart from the forex issues, just give us a sense of other burning issues that the domestic agric commodities market is actually facing.
Well, inflation for September should actually increase marginally, because we are seeing bumper harvest in the north and some parts of the eastern region as well. But then, like we said earlier, the imported food item is still a major issue because prices are still trending higher. But then price of rice has actually come down. Price of most commodities that are sourced locally are actually down. So we should see, and again, price of petroleum, price of petrol and diesel and kerosene, I mean, it's still relatively flat. So we shouldn't see a spike in inflation coming up, but there will be a marginal increase. Generally, domestic commodity prices are determined by two factors, which is the supply-demand dynamics. If there's favorable weather conditions, we obviously expect increased output, which will somewhat suppress prices. And on the other hand, the forex constraint, seeing that we are extremely dependent on importing most commodities for finished goods. So those are two separate issues. So on one hand, we're seeing some sort of improvement, and on the other hand, there's still some sort of uncertainty as to where the FX market is going to. So we still expect to see some sort of volatility in domestic commodity prices, especially the ones that have import content in them. But locally produced commodities, we expect to see prices stable. But then the upcoming, we have the Christmas season coming up, and seeing there's a lot of uncertainty, speculation, a lot of panic buying. I expect consumers to actually look into some sort of low prices now, and obviously if there's increased buying, prices will actually go up. So there's going to be a volatility in prices.
Oh well, so taking a look at your analysis, and that's what we have there, a price of elastic versus price of inelastic commodities, there's relatively no change from the last time we had conversations.
Yes. There's relatively no change. Like we do the market forecast, or like we do some sort of market analysis. Market women are, somewhat showing some sort of satisfaction, or the pressure is easing on them, because we're used to the high cost of transportation now anyway, and they've already factored that into prices of their products. So prices are flat for now, but we expect to see volatility in 2 weeks or in 3 weeks' time.
Ada, thank you so much for coming on the program this
morning. Thanks for having me.